Let's say a state-owned enterprise borrowed 100 from a local bank.
This loan is guaranteed by the central government. At some point later, the state-owned enterprise is unable to repay an installment of this debt because it has a temporary cash flow problem. Under the terms of the guarantee, the central government then pays this one installment on behalf of the state-owned enterprise. In this case, the financial relationship between the state-owned enterprise and the local bank remains the same.
What happens between the state-owned enterprise and the central government depends on whether the government has an effective financial claim in the form of either a debt instrument, such as a loan, or a non-debt instrument, such as equity, on the state-owned enterprise.
If the answer is yes, then the central government records an increase in its financial assets, such as loans. The counterpart entry is a decrease in its financial assets in the form of currency and deposits. The state-owned enterprise records a decrease in its original debt liability to the local bank and an increase in another liability to the central government.
This new liability could be in the form of a debt or a non-debt instrument.
If the answer is no, then it records an expense in the form of a capital transfer, which we classify according to the nature of the debtor.
The counterpart entry is a decrease in financial assets in the form of currency and deposits. At the same time, the state-owned enterprise records a revenue in the form of a capital transfer and a decrease in its original debt liability to the local bank.